Hey guys, welcome to the channel. My name is Max. I appreciate you guys being here. The channel's name is The Covered Caller. It's Saturday, so that must mean it's time for the top 20 high yield ETFs of the week. I have a universe of 157 high yield ETFs, which I track on a tick by tick basis. To be included in the max factor, the high yield ETF had to have been out for at least 3 months, and also it has to pay a yield of at least 5 or 6%. The max factor is my own proprietary metric that is a better take on total return. Total return can be deceiving in these high yield covered call funds. These high yield funds, some of them pay so much yield, they broke the metric. They broke the total return metric. The max factor looks at the elements of the total return metric, but I look at them separately. I look at the NAV return, I look at the yield, and I also look at the risk or in the volatility. I put those together and I have a better metric. I'm studying the interaction of how the yield affects the NAV return. All right, guys, thank you very much. Stick around. We'll get right in the middle of it. Today, we're going to start with the short-term max factor. Now, to be included in this, like I said a second ago, you have to have at least 3 months worth of data. So some of my favorite funds aren't in here yet. The one I'm thinking of specifically is QLDY from Defiance. Now, it's a really good fund that's based on an option strategy called the lightning spread. And I talk about it all the time. We've had multiple videos. That fund's doing really well, and I can't wait for it to be included. I think it gets included in early December. But if your favorite fund's not on here, it's either not 3 months old, or maybe it's some obscure fund that I don't know about yet. Drop me a comment and I'll put it in if it meets the qualifications. All right, guys, let's get in the middle of this. Number 20 on the short-term max factor. We're going to look at the long-term max factor after this, but the short-term max factor is the premier max factor. We do the long-term also just to give a broader perspective. Here we go, number 20. Wow, look at this, APLY. This is from YieldMax. Been around since April of 23, yielding a generous 36%. Price 90 days ago was $13. The price $13.31. The price Friday was $13.65. Stable NAV, 36% yield. Little bit of NAV depletion over the past year. Went from $17.47 to $13.65. This quarter, the NAV's up 25%. It's about 60% as stable or as volatile as the overall market. Let's go to the next one. QILD. This is from Global X, paying an 11.73% yield. NAV went from 1690 to 1736 just this quarter. That's not too bad. And this thing's pretty darn stable. It's 1.8 times as stable as the broader market. Next to number 18, we have SPIN. Now, SPIN is an interesting one. That's a S&P income fund, and it's from State Street. And State Street's the people that invented the SPY. That the SPY was the first index-based ETF to come out. I think there was other ETFs before, but it was the first index-based ETF where you could buy the entire S&P with one click of a button. Believe it or not, back in the 80s and 90s, early 90s, you couldn't do that. You would have to buy a basket of all 500 stocks to get exposure to the S&P. Well, it was a pretty big deal when when State Street came out with an ETF. I believe it was 93 or 94, and it allowed you with one transaction to get exposure to the entire index. It's something we take for granted now. In any event, this is based on the S&P, yielding about 8.5%. It's about 1.3 times as stable as the broader market. NAVs went from 30 and change to 31 and change, almost 32. It's NAVs up 5% this quarter. Good job, SPIN. Next to 17, we have SVOL. This is from Simplify. This thing's yielding 19.6%. NAV is up a little bit, up about 3% on the quarter. This has approximately market stability. All right, IWMI. Now, this is a good one, yielding 14%. NAV's up, about $2.50 this past quarter, which comes to about 5%. It's not quite as stable as the overall market, but it's about 80% as stable as the overall market. So fairly low risk in this one. Now it is based on the Russell. That's where the IWM comes from. And the Russell stocks tend to be smaller and a little bit more volatile. So that would explain to me why IWMI is more volatile than SPIN. Let's go to number 15. Number 15, TLTW. Now, this one's been hot lately because it's based on bonds, and bonds have been rallying. TLT is like the SPY of the bond world. Well, TLTW, it sells option premium on TLT. It's a liquid ETF, and, it does well as long as bonds do well. Well, bonds have been doing well. The NAV this quarter has gone from 22.80 to 23.35. It's only about 2% NAV return, but combine that with the 16% yield and combine it with something that's 1.5 times as stable as the broader market, you might have something here. All right, next we have Chippy. Now, Chippy is from YieldMax, and this thing is yielding 36%. The NAV's gone from 53.57 to 55.80. That's, it's up $2. I mean, not the worst thing I've ever seen. It's about 4%. Giving you a generous yield. It's only about half as stable as the broader market. All right, and next on the list is IWMW. Now, this one's also based on the Russell. The clue is the IWM part of it. That's the Russell ETF. So this thing is from State Street. Been around since March of 24, yielding 22%. NAV's, up a couple bucks, call it 4%. Fairly stable. It's more stable than the NEOS IWMI that we just looked at a second ago. And not by a whole lot. Let's do a little comparison on these two. Let's just go back since inception and run them against each other and kind of see what they do and how they pay you. All right, so IWMW from State Street. The NAV went from 46 to 40, so it depleted about 15% over 1.3 years. However, paid a $12 dividend over the same time. So, you lost 6 in NAV, but you made 12 in dividends. Not the worst thing that could happen. That comes out to a total return of 14%. You annualize it, it's still 10%. Not bad. Now, IWMI is from NEOS, and this thing's NAV went from 49.98 to 48.28. That dropped about $1.50 over 1.3 years. That's pretty good. It's better than IWMW. Unfortunately, it also pays a little bit less of a dividend, and that's the way these work. The ones that pay the higher dividend have more depletion. It's just math, just the way it works. But all things considered, when you look at the total return, IWMI is ahead. Now, unfortunately, on the max factor, for one thing, the max factor just considers the past 3 months. And the max factor also looks at risk-adjusted reward, and IWMW is ranked a little bit ahead of IWMI. I'd say they're both probably pretty good funds if you want exposure to the Russell. All right, next we have K-Gold. This is from our friends over at Curve. This is a Howard Chan fund. He does a great job. Now, this thing has not been out very long. It came out this summer, but in the past 90 days, it's gone from 24 to 28. 24 and change to 28 and change, making a 16% NAV return. Now, it's only about half as stable as the broader market, but it's doing a decent job, I think. Next, we'll look at IAUI. Now, I see another battle royale coming on. We'll compare IAUI to K-Gold here in a second. But let's look right here on the max factor. They're fairly close to each other. Let's look at the individual the components of the metric. So the yield was 11.7. Okay, which is basically the same yield as K-Gold. I mean, we'll call that a tie. Now, the NAV went from 49.30 to 53.27. So the quarterly NAV return was up 8%. Unfortunately, unfortunately for IAUI, K-Gold had better NAV return, and they had the same yield. Now, IAUI was about twice as stable, though. So it depends on what you're looking for. And the max factor has IAUI ahead of K-Gold, but they're close. Now let's just run it back since inception on both of them and see what we have here, see what we're working with. I bought K-Gold the other day, and I've been happy with it. I've just had it 2 days, but I've wanted it for a long time. And I also have KSLV, also from Curve. All right, so you can see here, going back a third of the year, which these funds have just barely been out a quarter, it looks like K-Gold just recently got included into the max factor. So maybe both of them have. I don't know how long IAUI has been around, but it's been around a little bit longer. Well, you can see here, K-Gold is, doing a little bit better. It's 18% total return as opposed to 13% total return. So K-Gold's a little bit riskier. It's one spot lower in the max factor, but if you look here at total return, it's winning. Now, also remember that IAUI was twice as volatile as K-Gold, so that also plays into the equation. Yeah, IAUI was twice as stable as K-Gold, and that's probably the reason IAUI is one spot ahead. But either one of those could work depending on what you're looking for. Next, we have Gold I. Okay, well, this is interesting. All the gold ones in a row. So let's check this out. NAV's gone from 159 to 168. So the NAV's up 5%, which isn't quite as good as the other two, although this one is even more stable than the broad market and pays a 14% yield. So I can kind of see why it's ranked ahead of the other two, but any of those three could definitely work. Let's run K-Gold against Goldie right now. Or Gold I guess is what I should call it, because we also have a Gold Y, which you could also call Goldie, I guess. And I don't know if Gold Y is going to make the chart, but it is in the max factor. I don't think it's going to be in the top 20, but we'll see. We shall see. All right, so K-Gold is just a solid winner looking at it from this perspective. All right, let's see who's number 9, SLVO. Okay, this one's based on silver. Now, this one's NAV has gone from $83 to $91. That's pretty impressive in a quarter. It's up 9%, and it paid a 17% yield. And, it's about 60% as stable as the broad market, as the SPY, for instance. All right, Silvo, let's see who's next. XYLG. Okay, this one has a metric or a asterisk, and I talk about it every week. I guess it paid a special one-time dividend or something. The true yield of this is around 6%, but because it paid that one-time dividend, it's showing a trailing 12-month yield of 22%. So just be cautious with this. Now, it's not without merit. I mean, NAV's stable. It went from 28 to 29, basically. It's 1.5 times as stable as the broader market. Positive NAV return, positive yield, even though it's really not 22%. If you buy it today, it's going to be more like 6. It's still could work depending on what you're looking for. All right, next is AMDW. I know someone that bought this the other day. Now, this thing has been a monster lately, or AMD's been a monster. It's based on AMD, and this is from our friends over at Roundhill. They do a great job. All right, so 90 days ago, this thing was at $53 on NAV. Now it's at $62. So the quarterly NAV return only, 17%. Doesn't even include the yield. Then you throw in the yield on top of that. Now, granted, the one drawback to this kind of fund is it's one of the least stable funds out of the 157 I follow. But, this one could work, but I'd expect kind of a wild ride for this one. All right, now let's go to Snowy. Snowy's number 6, been around since June of 24, yielding 76%. Wow. Now, the NAV's not doing nearly as well as AMDW. This is based on Snowflake and is from YieldMax. NAV went from 14 and change to 15 and change. And it's still 5% up. When you combine 5% positive NAV with the 76% yield, it's about twice as stable as AMDW also, but only about a third as stable as the broader market. So take that into consideration. Number 5 is iGold. All right. Well, it's been the week of gold, hasn't it? With the market pulling back, that really shouldn't surprise us. It doesn't surprise me. So this thing right here is yielding 15%. NAV went from 22 to 25 and a half, a 16% NAV return and a 15% yield. It's pretty balanced. You're getting about half your return in the form of NAV upside, at least you are this quarter, and you're getting about the other half of your return in the form of a 15% yield. Not bad at all. Let's run iGold against K-Gold. Let's see if anything can beat K-Gold. K-Gold is quite a ETF, and that's why I bought it. But iGold usually tests really high in the max factor also. These are close. They're closer than the other ones. Much closer than the other ones. All right, so let's go to number 4. Number 4 is TS2, okay, yielding 44%. This is based on Tesla. It's from Rex shares. Now, the NAV's gone from 24 to 27 and a half, basically. So that's a 14% NAV return, excluding dividends. And then you add in the dividend on top of that. And you have to also factor in it's not super stable, but it's based on Tesla. Come on. I mean, Tesla's not super stable. These things are lots of times a victim or a benefactor of whatever the underlying security is. All right. So number 3. Goop, would you look at that? Based on Google from Curve. Nice looking fund. Been out since November of 24. So just over a year. Or actually not quite a year yet. Coming up on a year. Yielding about 13.3%. Price 90 days ago was $29. The price the Friday was $36. This thing is up exactly $7 to the penny over the past quarter. So NAV return alone on this made you 24%. Yield was 13%. It's about half the volatility of the overall market. So, you know, this could definitely have a place in someone's portfolio. TSLP, this is another Tesla surrogate. Now, this one is this one's from Curve, from Howard Chan over at Curve. Now, look at this thing. So NAV 90 days ago was $20, 20 and a half. NAV now is 23 and a half. So it's up $3. That's a 15% NAV return only, 36% yield. Not super stable, but once again, it's based on Tesla. Let's run TSLP against TS2. They're both Tesla surrogates. I think this would be a fair contest. We'll see what we get. These are both good funds. I don't have any of either, but I wouldn't have an issue buying them either. I'm just not crazy about the single stock funds. I usually buy the diversified high yield funds. In any event, wow, look at this. TS2 is beating it on total return. Very good, TS2. They're both doing pretty darn well. TS2 is up 35% total return. TSLP is up 26% on total return. Who do you think's number 1? It's got to be, I'm trying to think. It's probably, I bet it's a Tesla surrogate. Or it could be an AMD surrogate. Let's see. We'll find out together. Oh, a Google surrogate. We have GUI from, GUI is from our friends over at YieldMax. Wow. Good job. Now, GUI is paying a 43% yield. NAV's up 10%. It's fairly stable, about half as stable as the overall market. Let's run GUI versus Goop. Wow, that is a good look for Goop and Curve. Although GUI is up 36% and pretty darn stable and pays a higher dividend than Goop. So one of these, both of these, or neither of these might work depending on your goals and your risk tolerances. GUI's yielding 42%, where Goop's only yielding 13%. However, Goop does give you more stability. Goop's about half as stable as the overall market, where GUI's, you know, a little bit less than half as stable. But when you throw everything in together and you look at risk-adjusted reward, according to the max factor, GUI is a pretty darn impressive ETF. All right, I hope your favorite ETF made it. Now we're going to go to the long-term max factor. Now, the long-term max factor we haven't been doing for the past couple of weeks because I haven't been happy with my metric for looking at the long-term max factor. The long-term max factor, you have to be in it, you have to have been out a year. And it looks at the past year's worth of data. The short-term max factor is a trading index. It considers momentum and volatility, but the long-term max factor considers volatility and risk, but it also considers after-tax total return. It's called, and I got the idea from a friend of mine, Mr. Ambassador Kwan, and he is on Twitter. Go give him a like and a follow. His idea was to call the metric real cash yield, RCY. I renamed it the long-term max factor, but I have to give credit to Jonathan. He's a smart guy, and he helped me design the metric. And so I think this is going to be really good. Like I say, the long-term max factor is more of a buy and hold type metric. And so that's why it's important that it's sensitive to tax consequences. Now, I do want to say the short-term max factor also considers tax consequences, but in a little bit of a different way. So let's see who we have on the long-term max factor. Here we go. Top 20 long-term max factor. Number 20, TSMY. This is from YieldMax. This is based on Taiwan Semiconductor, yielding 58%. NAV's flat on the quarter. Not very stable, but it's based on Taiwan Semi. What do you expect? Number 2, MSFY, based on Microsoft. All right, well, look at this. The NAV a year ago was $25. The NAV now is $26. So it has stable NAV, 14% yield, and it's pretty darn stable. 89% is stable as the overall market. We'll take that. Next one is QQX. This is from Nuveen, and this one has been out a long time, since 2007. It's a dynamic, they call it a dynamic overwrite covered call fund. Well, dynamic overwrite means they don't use the same formula to pick the options every time. They have some kind of guidelines they use, and depending on market conditions and other things, they might sell less than 100% of the options. They might go further out of the money. They might go further closer to the money. It depends on the metric. I don't care about any of that. I think it's interesting. Well, let's just see how these guys are doing. Are they protecting? Are they stable? Yeah, they're more stable than the broader market, and it's based on the NASDAQ. That's pretty good. Yielding 8%. That's kind of on the low side, but let's take a look at the NAV. In the past year, it's gone from 26 to 27. I mean, the past quarter, it's up 2%. So this is one that's on the safer side. All right, number 17, Devo. Now, this thing only yields 4.5%. The NAV is for the quarter's up 4%. For the year, the NAV is up about 10%. Super stable. Super stable. It's 1.6 times as stable as the broader market. So that could work depending on your goals and your needs. Number 16, QQI. Now, this is from Neos. This is a good fund. A lot of people like this fund, and with good reason, me included. This is the kind of fund I always say, if somebody made me stick all my money in any one of these funds, it might be something like QQI. It's one of those type of funds that's just a good all-around fund, and they do a solid job. It has a lot of history. It's been out since January of 2024. It's yielding 13%, which is, way more than QQX is yielding. It's about 60% more. NAV on the quarter stable. On the year, the NAV's gone from 52 to 54, also stable. As far as the stability metric itself, it has approximately market stability. Let's run QQI against QQX since inception and see what we have. Well, that is a close call. So, but I think you can see why the max factor has QQI ranked ahead, because it pays 60% more yield than everything else. The risk and reward of everything else, you can just tell by looking at it. It's very, very similar. Anyway, that's a great look for QQI. The Nuveen fund could work also, depending on what you're looking for. Let's see who's number 15. CanQ. Okay, now this is an interesting fund. This is from Calamos, and this is an income fund, but it's also a hedged equity fund. Well, hedged equity funds mean they use puts to put a floor on how far it can drop. So they try to cut some of the downside stability. Now, this is based on the NASDAQ. Considering it's as stable as the broader market, but it's based on the NASDAQ, That's pretty impressive. The broader market stability, I look at the SPX. So, you have about the same stability as something like the SPY, but it's a hedged equity fund. It shouldn't drop as far or as fast as the SPY. Now let's look at how it's performing, especially in a big down market. That's how these hedged equity funds are made. Price a year ago, $27. Price the other day, $30. I mean, pays kind of a lower yield, but they use some of their yield to buy the put protection. So that would explain the lower yield. All right, number 14, GPIQ. This is a good one. This is from Goldman Sachs, paying a 9.8% yield based on the NASDAQ. That's what the Q in it stands for. The NAV a year ago was 49, and the NAV the other day is 52. That's not bad. It's as stable as the broader market, and a little bit more stable in the broader market and based on the NASDAQ. So that's a good sign. We like that stability. All right, number 13 is Tuggen, T-U-G-N. I forget the company behind this. I used to know, but in any event, it yields 11.14%. A year ago, the price was 24 and change. The price on Friday was nearly $26. Good NAV return. Not quite as stable as some of the funds we've been looking at, some of the other funds we've been looking at in here, but it's 83% as stable as the broader market. We'll take it. Number 12, KQQQ. This is another one. If I had to put all my money in any one fund, it might be QQI or KQQQ. They're good funds. In fact, we might run QQI against KQQQ here in a second. Let's do that. Now, first of all, let's look at the metrics. Yielding 9.8%. Price a year ago was $26.86. Price now is $29. It's stable. It's not super volatile. Now it's about 80% as volatile as the overall market. So it's not as stable as something like GPIQ or something like QQI. But let's run the two funds that if I had to put all my money in any one fund, what I might put it in against each other. Well, look at that. Mr. Howard Chan from Curve strikes again. This man, Curve is something else. They're generally on the lower yield side, but Howard has a real knack for catching upside. And he's done it because QQI is a darn good fund that also has a knack for catching upside. In any event, either of these could work. That's not a huge difference. KQQQ's up 28%. QQI's up 23%. Great job, guys. Number 11, Babo. This is based on BABA. And this thing, NAV's down a little bit on the quarter for the past year. The NAV's also depleted about $3 or $4. It is paying a 73% yield, which can help cushion some of that depletion. Now, unfortunately, this one is not the one that's for widows and orphans. It is not very stable. It's about 4 times as volatile as the SPY. So take that into consideration if you're interested in that one. Clip. Now, Clip is based on KWEB, which is a ETF based on Chinese stocks, I believe. So they sell options on it. They make about a 33% yield. NAV for the quarter is down 0.5%. For the year, the NAV's depleted about $1.50. But you can pay for $1.50 worth of depletion if you have a 33% yield. So that's how it got on the list. It's about 70% as stable as the broader market. Number 9, GUI. Now, if you remember, GUI was number 1 on the short-term max factor. Now, on the long-term max factor, GUI's paying a 42% yield. Price a year ago was $15.53. It's $14.20 now. So a little bit of depletion. Stability about half as stable as the overall market. GLDI, okay. GLDI was also on the short-term max factor. So we've already looked at this. But the one year NAV situation is 153 to call it 169. So that's pretty dang good over a year, especially when you consider you're also paying a 14% yield and you're also about 25% less volatile or more stable, however you want to look at it, than the broader market. That one could definitely work in a portfolio. So could iGold. We've already looked at these. iGold's price a year ago was 22. Now it's 25.5. Great job, iGold, paying a 15% yield. Then we have IDEVO. IDEVO, been out since 2022. This is one of the kind of older funds here. Now, it only pays a 5.3% yield, but it had great NAV return this quarter. For the past year, the NAV went from $30 to $37. So no depletion there. And the stability's there. It's about as stable as a SPY. We'll take it. Now, Goop. Now, Goop is from Curve. Darn Howard shows up on this list a lot. Howard, the manager from Curve. He just has a knack for this kind of stuff. All right, well, this thing yields 13.38%. Price a year ago was $30. The price Friday was $36. That's pretty dang good. About half as stable as the overall market, but it's based on Goop. It's not based on 500 stocks. So that could explain some of the excess lack of stability or the excess volatility. Number 4, SLVO. We've already looked at this one. Price a year ago was 78. Price the other day was $91. Man, that's something else. And it yielded 78 or 17% on top of that. Decently stable. Then we have Snowy, based on Snowflake from YieldMax. Price a year ago was 17 and change. Price Friday was 15.17. So what is that? That's it's up $2.01 over the past year. Not bad. Not bad when you combine that with the 76% yield. A little bit on the volatile side, though. It's only about a 36 on the stability index, or a 0.36, meaning it's about 3 times as volatile as the broader market. All right, GDXY. Now, this one did not make the short-term list. This one's been pulling back lately. I had this one, but I sold all of it, and I got K-Gold and K-Silv with the proceeds from this one. This one had been doing really well, even on the short-term max factor, but anyway, it dropped off the short-term max factor, but it's still here on the long-term. Let's kind of look why. Price a year ago was 15, and change. The price now is still 15 and change, so it's up a little bit, stable, about a third as stable as the broader market. All right, so who do you think number 1 is? If you watched my afternoon show yesterday, you'll know because we already looked at it, but it begins with the P, it ends with the Y. It's from our friends over at YieldMax. Paul T, look at this thing. Been out for just about a year and a month and yielding 96%. A year ago, the price was $60. Now the price is $58. That's down $2, but you can pay for $2 depletion with the 96% yield. It's about 3 times as volatile as the overall market, or a third as stable, however you want to look at it. All right, guys, so that's it for the long-term max factor. I hope your favorite fund was on there. Please join me every weekday where I have a show called The Daily Factor. And what I do is I look at all of these. I look at the entire lineup. Here's all the funds in the max factor. There's 157 of them. And, we look at everything. Let's pull up the most stable funds. The most stable funds aren't always the best ones to invest in. Funds can be too stable, but it depends on what you're looking at for. FIAX is, almost 4 times as stable as the broad market. But in any event, we go through all of these metrics on a daily basis. And what I do is we'll break off a subset. Last night, for instance, we compared all the NASDAQ-based high-yield funds. The night before, we compared all the SPY, the S&P-based high-yield funds. Some nights we have Tesla Tuesday, and we'll look at all the high-yield funds based on Tesla. So be looking for that show every week. I'm on X at Max Convexity Man, and I'm also on YouTube at The Covered Caller. And please join me there, and I will talk to you later.